How to spot stagflation? One way is by looking at the copper to gold ratio and the crude oil to gold ratio. Gold reflects real money and investors' confidence. Copper tracks recession and crude oil represents inflation pressures. When real money is under threat, the economy slows and inflation rise at the same time, we have stagflation. This would be a worst case scenario for any economy. Fortunately, we are not experiencing it yet, though the risk remains. So what could trigger stagflation? My name is Con Hao. My work in this channel is to study behavior science and finance, discover correlation between different markets, and uncover potential opportunities. This analysis is based on technical studies and does not constitute financial advice. Please consult your licensed broker before investing. Copper is used in many industries. When copper prices slow down, it may signal a recession. Crude oil powers many vehicles, including ships and aircraft. When its price rises, everyone could feel the pressure and it may signal inflation. Okay, let's investigate what might trigger stagflation. First, by tracking recession, and then we will discuss about how to track inflation using copper, crude oil, and gold. Now let's get to the first topic. It is tracking the recession with this ratio. Copper gold ratio in yellow and the US GDP in white. And we can see that historically it moved in tandem. Let's take a few moments to study their relationship together. We could see that they move in line together over time from the 80s to today. And at present, the copper gold ratio is still pointing downwards, as we could see, signaling a potential recession. And for today's context, we know that gold is at the all-time high and is trending higher. So is the copper as well, is moving higher. It is also at its all-time high. Okay, but what caused this ratio to move down, to move lower? It is the rate of change, rate of appreciation, rate of depreciation, rate of percentage change on the upside and the downside. In this case, on the upside, meaning that the gold today is moving much faster than that of gold. So therefore, we are seeing that a downtrend in this ratio. So on the flip side, if gold and copper start to move down and copper rate of decline is faster than that of gold, we will see a similar downtrend signal. And it also signal that recession is near the corner or we are already in recession. Now, let's discuss about the next topic about how to track inflation. It is by this ratio, the crude oil to gold ratio in yellow and the inflation data in white. And again, historically, we could see that they move in tandem. And let's take some time to study them together, their relationship over the span of from the 80s and today. So at present, the crude oil to the gold ratio is pointing downwards, as we could see here, while the inflation data is pointing upwards. And we can see that there's, as of now, this time frame, we could see some divergence here. So for this study of this ratio, the risk of inflation continue to move up lies in the direction of the crude oil. Now, let's look at what did we study last week. So we discussed that we may see a technical breakup because of this consolidation, this triangle, and it was now at around 62 US dollars. Say, for example, a 10% gain in the crude oil that would bring us up to about 68 US dollars. And if gold maintained at this level, nothing have changed, but the crude oil start to move up. And what we are seeing here is that the crude oil and the gold ratio will start to tilt up. And when that happens, it also means that the inflation will continue to move higher. And a higher inflation, let's do a recap here, combined with a recession while gold remain elevated equates to stagflation. To recap, how to spot for stagflation. We recognize that the copper to gold ratio and the economy is currently moving downwards, signaling recession. And with the divergence between the crude oil gold ratio and inflation, I will be keeping a very close watch on the crude oil. So once the crude oil start trending higher, I will need to prepare for a potential stagflation. And I hope that this sharing is useful in helping us prepare for what may lie ahead. We cannot perfectly time the market, but it is possible to get the market timing right. The market are always telling us on their next move. Feel free to leave any comments below. I love to exchange ideas with you on what is about to come. Really happy that you stay through this tutorial. You have many great trading weeks ahead.